Hi students, so welcome back to class number 17 of CMA and Financial Management. We are in chapter number 1, decision making tools, and we are solving all the additional problems that is given in your study material. And there are 44 additional problems, and today we are going to cover problem number 38 and 39. So I think I have solved almost 90% of all the questions in the book. Only the 10% I have given for your homework purposes, which is very similar to what we have solved in our videos. So request you to take up the problems on your own, solve it, and just rewind and see the video so that any doubts that arise for you can be answered with the video itself. And even if it is not answered with the video, please post a comment and I will reply to you as soon as possible. So all the best guys, let's move to the today's problem. The following figures have been extracted from the accounts of manufacturing undertaking which produces a single product, okay, for the previous base year. Units produced and sold, so produced and sold is 10,000. So there is no inventory that is created because of this production. So fixed overheads is 20,000. Okay, so fixed cost is given, labor cost 4 rupees is given, material cost 2 rupees is given, overhead, so these are all variable overhead, so these are all variable costs, so variable overhead is given 0.8 rupees, selling price is also given, so selling price is there, variable cost is there, contribution can be found, fixed cost is there, unit produced is also there, so total contribution can be found, minus the fixed cost you can also find the profit. Okay, let's see what the question is asking us. Okay, in preparing the budget for the current year, because all the data which we saw till now is for the previous year, so we are preparing the budget for the current year. Okay, the undernoted changes have been envisaged. Units produced and sold is 15,000 for the current year. During the budgeting, these are the inputs received from various teams. We as a finance department receives inputs from all the functions and we prepare the budget, and all the budget gets sanctioned from various top level authorities, and then we issue to the various function who has given us budget. This is the approved budget. You have asked for this, but this is the actual budget that you have got to achieve this level of production or this level of activity. So 15,000 is the production and sold. Fixed overheads is increased by 5,000 rupees. Fall in labor efficiency. So guys, always carefully remember when there is a word called labor efficiency. When labor efficiency is falling, the same labor who is doing the work will take more time to do the same work. Okay, which means the labor cost will go up. For example, fall in the material cost. What happened? Material cost will go down, but fall in the labor efficiency, labor cost will go up. Okay, so remember this, labor efficiency is inversely proportional to labor cost. Okay, material cost will be directly proportional to the total material cost. Okay, fall in the material cost will fall in the total material cost. Okay, however, labor efficiency, if it falls, it will increase the labor cost. How? Labor is doing the job less efficiently, which means he is going to take more amount of time to do the same activity. So more amount of time of him is invested, his per hour rate is constant, so his total hourly rate for doing the job is going to increase. Okay, so this is very important input. I have seen many students have done mistake in fall in the labor efficiency. Okay, it's just how we are perceiving the data. Okay, next is special additional discount on bulk purchase material. So there is a discount in raw material cost 2.5%. Variable overheads is reduced by 1 by fourth. So 1 by fourth is 0.25. So 1.25 percentage variable overheads has gone down. Next, fall in the selling price of 10%. Okay, so what we have to find, the number of units that must be sold break even in each of the 2 years, which means the previous year data which is already given to us, and the current year for the budget we have the data for that also. So what we are going to do, we are going to find the break even in each. So how much number of units? So break even units, break even in not in rupees, in numbers in units. Okay, so number of units which would have to be sold to double the profit of the base year. Okay, so double the profit of the previous year, how much units has to be sold? So number of units which has to be sold in the budget year, which means in the current year we are creating the budget for it to maintain the profit level of the preceding year. The previous year, the same profit I have to run. So how much units has to be sold? This is a very simple problem, guys. Similar problems we have already seen. Okay, but bits and pieces. So break even point we have seen separately, marginal costing philosophies we have seen separately, we have seen separately the break even point in units, uh, the target profit, what is the units required to be sold to achieve the target profit. We have seen all this type of problem in a bits and pieces, but here all the questions are consolidated. This is a consolidated question. You may get it for 4 marks or 6 marks. So let's go to answering. So this is the previous year data. There is no doubt in the previous year 10 rupee selling price is given, 2 rupee material cost is given, 4 rupee labor cost is given, 0.8 variable overheads is given. So I have compiled all this data and total variable cost is taken. Selling price minus total variable cost contribution can be found, and unit produced and sold, it is given 10,000 units. So 10,000 units I have sold into contribution per unit is 3.2. So if I multiply, total contribution can be found, which is 32,000 rupees, and 20,000 is the fixed cost that is given, and 32,000 minus 20,000, profit will be 12,000. And we all know okay, so fixed cost divided by PV ratio is going to be the break even point sales. So PV ratio has to be found. What is PV ratio? It is nothing but the contribution margin. Contribution divided by sales is called the PV ratio. So we have found the PV ratio, and fixed cost divided by PV ratio. We can also find the break even point sales, but this is in rupees. But question is asking number in quantity. So how to find the quantity? Sales is 62,500 divided by selling price is 10 rupees. We can find the break even point in units. So till now we have seen problems in which break even point sales is only asked, but here we have the selling price data. So divided by selling price, it's going to give you the break even point in quantity. So that is the previous year data. Now we are going for the current year. Lot of changes has been given. The first thing is the number of units has been changed from 10,000 to 15,000. That change we have implemented. Fixed overheads is increased by 5,000. Yes, fixed cost is 20,000. That is increased to 25,000. Fall in labor efficiency of 20%. Okay, 20% labor efficiency is fallen. So which means the remaining efficiency is 80%. Okay, and this labor efficiency is inversely proportional to the labor cost. So 80% should not be multiplied with the labor cost. So current labor cost is 4 rupee. 4 rupee multiplied by 80% will be something lesser than 4 rupees. That is where the students make the mistake. Fall in the labor efficiency is not fall in the labor cost. Fall in the labor efficiency will cause increase in the labor cost. So what you have to do is divide by 80% because it is inversely proportional. Labor efficiency is inversely proportional. So in this case, 20% fall in the labor efficiency. So prevailing labor efficiency is only 80%. So divide the 4 rupees by 80% so that you will get the correct labor efficiency. So in this case, 4 rupees should be divided by 80%. So 5 rupee will become the labor cost. So labor cost has gone up because of fall in the labor efficiency. Okay. So next is special discount for the bulk purchase. So 2.5% discount you have got. So 100 minus 2.5 is 97.5%. So material cost has gone down. Next, variable overheads also you have got a reduction. So which is 1.25%. So 100 minus 1.25 is 98.75%. So the variable overheads has also gone down. Last data is selling price is reduced by 10%. So selling price is current is 10 into 90%, 9 rupees is the selling price. So do the same math. You can find the break even point sales. You can find the break even point in units also. However, this scenario is bad because you are getting a loss of 6,100 in this calculation. So that is one point. Yes, so it is a loss in the current year. So then next question is to double the profit of the base year. So base year we can find the profit is 12,000. If the profit has to be doubled, so profit has to be 24,000. If the profit expected is 24,000, what okay, selling price minus variable cost is contribution. So what is the duty of contribution? The duty of contribution is to take the fixed cost and generate profit for you. Okay, so the profit required is 24,000 and fixed cost in that case is 20,000. So 20,000 plus 24,000, 44,000 is the duty of contribution that has to be taken. So the total contribution required for you is 44,000. We already have contribution per unit. Contribution divided by contribution per unit. What is it going to give you? Number of units required to achieve this profit. So it is going to give you 13,750 as the units. So we be very careful. So number of units which have to be sold in the budget year, which means the current year, to maintain the profit level of the preceding year. So preceding year, what is the profit? 12,000. If 12,000 has to be the profit and fixed cost is 25,000, we should not miss the data. Okay, 12,000 of the previous year has to be the profit in the current year. Then how much unit you have to sell? Then you have to take 12,000 the profit. You have to recover the fixed cost also, which is 25,000 in the current year. Okay, you should not take the old fixed cost, which is 20,000. In the current year, fixed cost is going to increase by 5,000. So 20,000 plus 5,000 is 25,000. So you have to take total contribution of 37,000 to achieve this. So contribution per unit in that current year 1.26. Okay, so divided by 1.26, 29,365 units you have to sell to achieve the previous year profit. Just think guys, in the last year you have sold 10,000 units and achieved the profit. In the current year, since the product dynamics, the costing has completely changed, because of that you have to sell 29,000 units to achieve the same profit. So just see, this is the real time scenario. Many companies will face this kind of pressure. If they could not reduce the selling price, their sales volume will go down. Ultimately, they become unprofitable. They could not pay their employees. They could not pay to their creditors, and it will become a uh, it will become a bankrupt company. So these are all a very practical scenario. So the costing is such a active role. So cost and management accountants role will be very active in all the factories. This kind of scenario you will come across in your job many a times. Okay, so let me move to the next problem. Vinag Limited, operating at 75% level of capacity, produces and sells two products A and B. So after producing A and B, but they are operating at 75% capacity only. The cost sheets are given below. Units produced and sold is given. Direct material is given. Direct labor is given. Factory overhead is given, out of which 40% is fixed. So 60% is variable. Next, selling and administration overhead is given. 60% is fixed. So 40% is variable. Okay, so which means, okay, so total cost is given here, that is total cost. We are not worried about that because we will we are doing marginal costing, so we will split into fixed and variable, and this total cost is irrelevant for us. Selling price per unit is given for us. Okay, so we have the selling price, we have the direct material, we have the direct labor, factory overheads we have. Out of that variable component we can take it out. At same way, selling and administration overhead, we have variable component, you can take it out, and you can add it up to find the total variable cost. Selling price minus total variable cost will give you the contribution. Okay, so this is the same philosophy that we are speaking for many classes, so I am not going to explain in detail. So we are coming to contribution per unit, and we have also got how much percentage factory overheads, fixed component also on per unit level, it is already given. So fixed cost is also the balance. Factory overheads 40% is fixed, 60% of selling and administration is fixed. So I am applying the fixed cost also on per unit basis. So total fixed cost is also applied, and profit can be found here. So what is our objective here? The factory overheads are absorbed on the basis of machine hour, which is the limiting factor. So this company has a policy, okay, of absorbing the factory overheads to the product on the basis of machine hour. Okay, and that machine hour is a limiting factor. Okay, so limiting factor problem we have seen here. Machine hour is a limiting problem. The machine hour rate is 2 rupee per hour. The company receives an offer from Canada for the purchase of product A, okay, at price of 17.5. Product A currently you are selling at 23 rupees, but Canada has given you some offer. 17.5 rupees is their take rate. Okay, so which means it is lesser than our current selling price. Alternatively, the company has another offer from Middle East for the purchase of product B. Okay, this time it is product B from Middle East at a price of 15.5. Okay, currently you are selling at 19 rupees, maybe for the domestic market or the export one. 19 rupees is your current selling price, but You have got an offer from Middle East for 15.5 only. Let's see if it is viable or not. In both the cases, a special packing charge of 50 paise per unit has to be borne by the company. So which means for sending this item through sea to the relevant countries, you have to make a more worthy packing. Okay, so for that 50 pies per unit you have to spend. Okay, the company can accept either of the two export orders. So any one can be accepted, and in either case, the company can supply such quantity as may be possible to produce by utilizing the balance 25%. So here they have clearly said 75% capacity is already utilized. Only with the remaining 25% you have to serve either of the two offers. Either you can serve Canada or you can serve the Middle East offer, but whatever you can serve is only with the remaining 25% capacity what you have. You are required to prepare statement showing the economics of two export proposals, giving your recommendation as which proposal should be accepted. Yes, we can do that. A statement showing overall profitability of the company after incorporating the export proposal recommended by you. Okay, so which proposal is best, whether to send to Canada or Middle East, and whichever you choose, incorporate that to the current already you are running at 75% capacity, right? What is the profit of that, plus which is the best, Canada is best or Middle East is the best, incorporate that also within your statement and find the overall profitability. So this is what is the question. Okay, so here we have found the profit per unit sold also we have. Okay, so contribution per unit we have already found. So contribution per unit multiplied by the unit sold, it is already given 600 and 400 is the unit sold of product A and product B. That is the current 75% capacity operation. Okay, so the total contribution can be found. So guys, contribution per unit we have already calculated, multiplied by the unit sold will give you the total contribution, and factory overheads is given. Total factory overheads 5 rupees and 3 rupees that is taken, and 2 rupee is per hour rate. 2 rupees is the per hour rate. So the factory overheads divided by per hour rate will give you the machine hours required. Okay, so factory overhead divided by per machine hour rate will give you the machine hour per unit. So now you have found the machine hour per unit. So in the limiting factor problem, always what we used to do, the contribution divided by machine hours or the limiting factor. So here we have found the machine hour. So contribution per machine hour, we know the contribution per unit is 10.8. 10.8 divided by 2.5 will give you the contribution per machine hour. Okay, so contribution per machine hour, which is best? Okay, here we need not compare because product A and product B we have found the contribution per machine here. Okay, here the most important data is, guys, at 75% level of capacity, the total contribution you have found, you have with the company is 6,480 from product A and 2,880 from product B. So you can total it down. That is the total contribution at the 75% level of capacity. With balance 25% capacity, we are going to serve either Canada or Middle East. So whichever is the most profitable, we will serve. And what is the contribution from that order that we will add to these numbers? So 6480 and 2880. So remember this. We will add the further contribution from any one of the order, any one of the offer which we accept. We are going to serve that through the remaining 25% capacity that we will add to this. We will find the total contribution as a whole. That is the second question that is asked. Now we will analyze which of the two proposal is profitable, Canada or Middle East. So guys, we are analyzing the Canada offer and the Middle East offer. So the Canada offer we have got for 17.5 rupees and this is 17.5 rupees, and we have got from Canada for product A and put all the costings of product A. Please don't miss the special packing 50 paise which is given in the question. For Canada and Middle East, we have got additional cost of 50 paise per unit. So that has to be added. That is for the special packing. So the total variable cost is increased by 50 paise. So the total contribution can be found. Same product here we have already seen in the previous slide. What is the machine hour per unit? So machine hour is the limiting factor. So we have the contribution per unit. We have the machine hour per unit. So contribution per machine hour can be found to be 1.92 rupees. Same way for Middle East, we have got the offer for product B for 15.5 selling price per unit. So do the same math, apply the same costing, just increase the costing by special packing 50 paise additional is required. Add that, so variable cost will go up by 50 paise. Contribution per unit can be found. Machine hour per unit also we have found in the previous slide. Apply the same machine hour per unit. We have the contribution per unit, we shall have the machine hour per unit. Contribution per machine hour can be found, which is 2.13. So if you compare these two, the higher contribution per machine hour, Middle East offer is giving you the higher contribution per machine hour. So we are selecting Middle East offer. So many students, what they do, they will compare the contribution per unit. If you see, contribution per unit of Middle East is only 3.2, but contribution per unit of Canada is 4.8. So they will select Canada and take the profitability of that and go ahead. You may go in the wrong path, but which is right? Contribution per limiting factor. So whenever a question has a word called limiting factor, we should find the product, we should select a product which has a higher contribution per limiting hour. Material may be a limiting factor, labor hours may be a limiting factor, but in this question, machine hour is a limiting factor. So contribution per machine hour, whichever is higher, will be selected. And in this case, Middle East offer is having the higher contribution per machine hour. So we are selecting the machine hour. Middle East offer. Okay, so we are already running at 75% capacity, and we have generated some contribution also from product A and product B at 75% level of capacity. Now we are going to select this Middle East offer, and this will be served only through the remaining 25% capacity. How much units can be produced with the 25% capacity? That we have to find. Let us see that in the next slide. So we already know the machine hour per unit is 2.5 for A and 1.5 for B, and we know how much is already produced, 600 and 400. We can multiply and find the total machine hours that is utilized is 2100, which is 75% capacity. So 75% capacity is 2100. Then 100% capacity is what? Divided by 75% multiplied by 100% of 2100 will give you the 100% capacity. So what is that? It is 2800. 2800 machine hours is your full capacity, out of which 75% you have utilized, which means 2100 you have already utilized. So balance left out is only 700 hours. So this 700 machine hours you are going to utilize for creating the product for the Middle East. So Middle East has asked product B, making product B for Middle East. So product B, what is the contribution per machine hour? 2.13 rupees is the contribution per machine hour. Now you know how much machine hour is allocated. 700 balance hours is going to be given for product B only. So 700 multiplied by 2.13 is the contribution per machine hour, which we saw in our earlier slide for the Middle East costing. So the total contribution you are generating from the remaining 25% by serving to the Middle East country with product B, we are going to get a contribution of 1493. This is added to our existing profit. What is the existing profit at 75% capacity from product A and product B? By selling at 6,600 units of product A, 400 units of product B, we have already made a profit of 6,480 from product A and 2,880 from product B. Add 1,493 by serving Middle East also to this, the total contribution will come to 10,853. Okay, this is the overall contribution minus fixed cost will give you the profit. So how to find the fixed cost? We have already 40% of factory overhead is fixed. So you can multiply the per unit factory overheads by 40% per unit fixed can be found, multiplied by the 600 and 400 respective quantity, multiply by that quantity, you can find the fixed factory overhead. Same way you apply and find the fixed selling and administration overhead. Total it, you will get 5,760 as the total fixed cost. Fixed cost will not change. Let it be 75% capacity, let it be 100% capacity, fixed cost is going to remain constant. So 5,760 is constant. If you reduce that, the overall profitability is 5,093. So guys, I know this problem is a very challenging problem. There is a high probability you may go wrong in calculating the contribution, calculating the contribution per machine hour, whether to accept Canada or Middle East. And if you have done all this correct, you may go wrong in calculating the fixed cost. Okay, or you can also go wrong in calculating the balance machine hours that is required, or you may get stopped here. How to proceed, how to incorporate the Middle East profitability with the current profit. So this is having a lot of turning points. So this problem is really challenging. It may be a 8 marks problem minimum. So rewind and watch the video. I request you to read the question from your book and solve it on your paper. Whatever questions you get, watch the video and get it answered. And if there is any unanswered question, note it down and drop a comment, a consolidated comment. I will answer you as soon as possible. So all the very best, guys. Meet you in the next class very soon. Thank you.